Welcome back to the deep dive. We're here to cut through the corporate jargon, find the story in the numbers, and basically hand it straight over to you. Today, we're tackling PTG Industries' third quarter 2025 results.
That's right.
And on the surface, things look pretty good. Record Q3 adjusted EPS, $2.13. That's up 5% year over year. And they managed 2% organic sales growth overall. So our job today is really to figure out what's under the hood here. How did they actually deliver sales volume growth again, third quarter in a row, especially when the CEO himself called the macro environment very challenging?
Yeah, that's the key tension, isn't it? And if you really look through the source material, the story is quite fragmented. You've got these pockets of, well, really strong performance in specialized industrial areas like aerospace, packaging.
Okay.
But they're working against this kind of deep, ongoing slump in some key consumer-facing businesses. Automotive refinish is the big one there.
Refinish. Right.
So the main theme really is that this growth isn't just the market lifting all boats. It seems much more operationally driven. PPG looks like they're successfully grinding out share gains through better commercial execution, even when the actual industry demand is, well, choppy or even weak.
That's a critical point, share gains versus just riding a market wave. Okay. Let's start with the top line then, the overall scorecard. $4.1 billion in net sales.
Yep.
Built on both volume growth and price growth. That feels like a healthy operational sign, right?
Absolutely. And when you trace where that organic growth actually came from, it's very, very concentrated. You see these double-digit organic sales jumps in three specific spots: aerospace coatings, protective and marine coatings, PMC and packaging coatings.
So those are the engines doing the heavy lifting?
Pretty much. They're the ones offsetting weakness elsewhere in the portfolio.
And the 5% EPS growth, it can't just be revenue. There has to be some efficiency play there, too. What did the sources say about costs and, capital?
Well, it looks like it's underpinned by some pretty aggressive cost management, which we've kind of seen from them consistently over the last few quarters. And they're still returning cash.
How much?
$310 million back to shareholders. Just in Q3, that's dividends and buybacks. It brings the year-to-date total to a pretty hefty $1.2 billion. So the balance sheet is clearly strong enough to handle both growth investments and keeping shareholders happy.
Okay, now we have to tackle the paradox. The big drag on their performance coatings segment, which is usually very profitable, was automotive refinish. You mentioned it. Organic sales volume down double digits. How does a high-margin pillar like that struggle so badly when other specialty areas are booming?
Right. This is the refinish riddle, as you put it. And it seems to be a two-part issue. Part one is, well, fairly straightforward supply chain stuff. Distributor orders were really front-loaded into the first half of 2025.
Okay. So some destocking was expected.
Exactly. Q3 saw that anticipated end-of-year destocking kick in. But the deeper issue, the one that really tells a bigger story about the economy right now, is this slump in U.S. collision claims. And that seems almost entirely driven by insurance dynamics.
Insurance, really?
Yeah. The sheer cost and, frankly, availability of auto insurance have just put a lid on claim submissions. We saw insurance rates growing, get this, at a 16% compound annual growth rate, CAGR, between 2022 and 2024.
13%? Wow.
Yeah, huge jumps. And that basically scared people off submitting smaller claims, trying to avoid even bigger rate hikes down the line.
So it's not just a standard economic cycle thing. It's volatility in a completely different financial market insurance pricing acting as a brake on the entire body shop industry. That's quite a specific headwind.
It really is.
PPG thinks claims will normalize around mid-2026. That feels quite far off. Is that just based on hoping insurance rates stabilize, or is there something else driving that date?
It seems mostly tied to the expectation that premiums will eventually flatten out, letting claim submission rates creep back to normal. The market just absorbs so much price volatility so quickly. But you're right, PPG isn't just sitting back and waiting. Their counter move is all about forcing share gains by selling productivity solutions into this tough environment.
And that's where things like their LA&Q subscription service and the Moonwalk automated paint prep hardware come in. I saw they've installed over 3,000 Moonwalk units now.
Exactly. It's a direct pitch to body shops saying, look, claims are down, you need to be more efficient to survive, and our tech can help.
Makes sense.
They're betting that the shops that invest in productivity will be the winners, and technology is their way in. And actually, there was a fascinating bit in the sources about an innovation involving artificial intelligence in chemistry.
AI in chemistry. Tell me more.
So PPG launched this new product, the Deltron Premium Glamour Speed Clear Coat. And apparently, it was fully designed using their own proprietary AI. The whole point of this formulation AI, as they call it, is to rapidly figure out the best chemical mix to get both a top-quality finish and faster application speed for the painter.
Optimizing the trade-off.
Precisely. And they're not stopping there. They expect to commercialize something like 50 products designed using this AI by the end of 2025. So they're really trying to innovate their way through this downturn in refinish.
That's quite a pivot from just chemistry to, well, high-tech materials science driven by AI. Okay, so while refinish is battling these insurance headwinds, industrial coating seems almost immune. Strong volume growth, 17% EBITDA margin. What's making them so resilient?
Yeah, their execution in industrial looks exceptional. Automotive OEM sales were up 8%. That's double the global light vehicle production growth rate of 4%. And they outgrew the market in every major region.
Impressive.
And we also saw packaging coatings hitting double-digit organic growth again. That points to real share gains, probably driven by having better tag for things like, two-piece cans and other specialty packaging. Industrial is just capitalizing on being different and better, it seems. Unlike architectural, which is still a bit of a mixed bag.
Okay, let's turn to global architectural coatings then. Organic sales were basically flat, right? Low single-digit % change. Where did it work and where did it struggle?
It really breaks down by region. They saw some decent resilience in Mexico, mid-single-digit organic growth there. Seems like solid retail demand helped.
Okay.
But that Mexican strength was basically just offsetting major weakness in Europe, especially Western Europe.
What's driving the weakness in Europe? Just the general economy?
Pretty much. Lower sales volumes across EMEA. They pointed to, soft consumer confidence, high inflation still, those restrictive interest rates, geopolitical worries, energy uncertainty, all hitting construction. But what's really interesting about their European business, despite the volume slump, they've managed to deliver price growth consistently every single quarter for 9 years straight.
9 years. Wow. Even through all the recent turmoil.
Yep. That says a lot about their pricing power and brand strength, doesn't it?
Yeah.
Even in really tough market conditions.
It certainly does. Okay, so summing up, industrial looks strong. Refinish is volatile because of insurance. Architectural is a geographical split. But looking at where they're putting their big money, the headline has to be the huge investment in aerospace. Over $500 million. Why such a massive commitment right now, given everything else?
Yeah, that commitment really underscores their long-term strategy. Focus on high-margin, specialized growth areas. And aerospace isn't just growing, it seems to be accelerating. It delivered double-digit organic sales growth again, set records for quarterly sales and earnings.
Okay, strong performance.
And crucially, it's already about a third of the whole performance coating segment, and its margins are accretive, meaning they actually pull the average segment margin up.
Okay, so it's a profit driver too.
A big one. And the growth outlook is strong. It grew at a mid-single-digit CGR over the past decade, but PPG is now expecting that to accelerate to mid to high single digits over the next 3 years. That kind of forecast justifies the big spend.
Still, $500 million is a lot of capital to deploy, especially with uncertainty elsewhere. What makes them so sure about this bet? Is that $500 million just keeping the lights on, or is it mostly for new growth?
Oh, it's heavily skewed towards future growth capacity. The breakdown is roughly $380 million for a completely new, state-of-the-art manufacturing plant down in Shelby, North Carolina. That's slated to come online in 2027.
Got it. New plant.
And the rest, about $150 million, is going into expanding their current facilities, with work planned through 2028. So yeah, they're building capacity now for demand they see coming over the next decade plus.
And are they just making more paint for planes?
Well, that's the other key part. They're actively shifting how they sell into aerospace, moving beyond just coatings to become more of an aerospace solutions provider. This means a much bigger focus on things like highly specialized sealants.
Sealants?
Yeah, including some really sophisticated stuff, even 3D printed sealant components for military aircraft, apparently. And also transparencies, things like canopies and windshields. By bundling these together, their actual dollar content per aircraft goes up significantly. That's how they plan to keep those high accretive margins going.
Okay, that makes sense, expanding the offering. So let's tie this all together. What does it mean for the near term? The sources confirmed they revised the full-year guidance down slightly to $7.60, $7.70 adjusted EPS. Mostly because of that extended drag from automotive refinish, right?
That's right. The guidance is basically signaling, look, the macro environment is expected to stay pretty choppy. And specifically for PPG, you should probably anticipate a soft first half of 2026.
Why specifically the first half?
It's kind of a double whammy. You've got the ongoing industry volume issues in refinish carrying over, plus they'll be up against really tough comparisons from the first half of 2025 when distributors were buying very heavily.
Ah, that front-loading effect again.
Exactly. It just creates a significant operational headwind for the next couple of quarters.
Makes sense. What about costs? Raw materials, are they still seeing inflation there?
They confirm they expect low single-digit inflation for the full year.
Yeah.
It actually sounds like the broader, kind of sluggish macro environment might be shifting the power dynamic a bit. Upstream suppliers seem more interested in securing volume deals rather than pushing for big price hikes right now.
So maybe some relief on the cost side.
Potentially, yeah. It's certainly a more supportive trend for their cost structure heading into 2026 than, say, a year ago.
Okay.
So if you zoom out and look at the whole picture from the sources, you really see this theme of resilience. Yes, they've got multiple end markets doing very different, sometimes volatile things, but that core strategy, pushing for organic growth by gaining share with better technology, differentiated products, and just relentless operational execution that seems to be working. They're controlling what they can control. And that includes making big strategic bets like aerospace, even when things feel uncertain.
That's a powerful takeaway, the focus on operational strength, overcoming market weakness in key areas. And it leaves us with an interesting thought, doesn't it? We've seen how these soaring insurance rates have hammered the collision repair business, pushing shops towards efficiency tech like the moonwalk just to cope.
Right.
But what happens if inflation trends do cool off and those insurance costs start to normalize, maybe heading back towards historical levels? Could that suddenly unleash a flood of all those deferred collision claims back into the system? And could that actually challenge the refinish industry's capacity to handle the work in 2026 or beyond?
That's a fascinating question. A potential bottleneck swinging the other way.
Exactly. Something for you to think about as the industry waits for that normalization. Okay, that's all the time we have for this deep dive into PPG's Q3 2025 performance. Thanks for joining us.